Today I would like to analyze UnitedHealth, one of the largest health solution companies in the world. In the last month, the stock price is down around 30%. The reason for that is their latest published financials. The revenue is up around 10% for the year, but missed the expectation by 1.75%. They also missed the expected EPS by 1.3%. The free cash flow margin increased around 0.4%, and also the customer increased by around 400 million customers. So all in all, I don't think that are bad financials for this quarter, but the expectation were too high for this company, so the stock price dropped significantly. We're gonna take a look at the financials to find out if this company is a good buy right now. The first thing we can recognize is a huge market cap of 389 billion US dollar. This makes UnitedHealth the largest health company by the market capitalization. We also have a dividend yield of around 1.97%, which we can see here did grow in a good rate in the last 10 years. This is something we like to see as well. Now we're going to take a look at the financials. The first thing you're looking for is revenue growth in the last 5 years. You want to invest in a growing business and not a declining business. So we can see here in 2020, the revenue was around 257 billion US dollar. This was a 6% increase from 2019. Then in 2021, we had an increase around 12%. This is something we like to see. 2022, around 13% increase, very good as well. 2023, around 14.6% increase, very good. And in 2024, around 8% increase. So overall, I think we had a good revenue growth in the last 5 years. So it's a check here. The next thing you're looking for is free cash flow growth in the last 5 years. A very important number because it can be used to pay the dividend, to pay the stock buybacks, to invest in the business, and also to pay back the debt. So in 2020, the free cash flow was around 20 billion US dollar. This was a 22% increase from 2019. So a very strong growth, so probably related to COVID. Then in 2021, we had the 1% decrease. So this is also understandable because the year before we had the strong growth as well. Then in 2022, we had the strong growth again around 17%. This is something we like to see. 2023, we had the strong growth around 10%. And then in 2024, we had a decline around 20%. So this is something we don't like to see. But overall, I would say in the last 5 years, we still had the free cash flow growth. So it's a check here. If we take a look at the operating cash flow, we can see the operating cash flow increased since 2020 in every year except of 2024 with a 16% decline. So if we compare to the free cash flow, we can see we had a decline already in 2021 around 1%. So the reason for that is the capital expenditures increased as well. We can see here the capital expenditures increasing in every year since 2020. So I think this company investing more money into the business. We can also take a look for the reason of the free cash flow decline in 2024. So we can see here Change Healthcare cyber attack. So the cyber attack had a significant effect on the free cash flow as well. Then we have the higher medical expenses and also the timing of the payments. So overall, I think this is the reason for the free cash flow decline in 2024. The next thing you're looking for is a free cash flow yield over 4%. So this can also tell us about the valuation of this company. The higher the free cash flow yield, the higher the indication for undervaluation. So what we're going to do now, we're going to take the free cash flow from 2024. So this is around 20.71 billion. We're going to divide it with the current market capitalization, 389 billion. So then we're going to get the free cash flow yield for 2024. So the number we get is around 5.32%. So this is over 4%, so it's already a check here. And I think this can be an indication for undervaluation right now. I think we should also consider the free cash flow in the future. Let's make some assumptions about that. If we ask ChatGPT, we can see here, this was the number 28.6 billion US dollar before the earnings miss, and now after the earnings miss, around 27.8 billion US dollar. So this is the expected free cash flow for the next years. In 2026, around 32.8 billion US dollar. In 2027, around 35.7 billion US dollar. So I think this earnings or this free cash flow might be too high. So let's just assume that in 2027, the free cash flow could be around, let's say 33 billion US dollar. So we're going to take this number, then we're going to divide it with the current market capitalization of 389. And then we're going to get a free cash flow yield assumption for 2027. So let me know in the comment if this assumption is too high. So the free cash flow yield would be around 8.48%. So this would be a high free cash flow yield, and this would be an indication for undervaluation to me. The next thing we're looking for is a debt to free cash flow ratio under 5. This means the company can pay back the debt with the free cash flow in under 5 years. A very important number, because if the company has too much debt and cannot repay the debt, it can risk to go bankrupt. So first we're going to take a look at the long-term debt. This is around 72.3 billion US dollar. Then we're going to take a look at the short-term debt as well. So the short-term debt we can see here around 1.3 billion. We're going to add this as well, this 3.2 billion. So round about 4.5 billion. Then we're going to divide it with the current free cash flow. The current free cash flow around 20.71 billion. So then we're going to get the debt to free cash flow ratio for 2024. So the number we get is around 3.7. So this means in round about 4 years, we can repay the debt with the free cash flow. So I think it's a good number. It's a check here. We like to see that. We can also take a look at the cash on hand. So how much this company has in the bank. We can see here around 25 billion US dollar. So this is also a good amount. So overall, I think this company has a good balance sheet. The next thing we're looking for is the enterprise valuation to free cash flow ratio under 25. So this can also tell us about the valuation of this company. The lower the number gets, the higher is the indication for undervaluation. So first we're going to calculate the enterprise valuation. So this is a market capitalization of 389. Then we're going to add the debt. So the debt is around 76.8. Then we're going to take minus the cash. The cash is around 25.3. And then we're going to get the enterprise valuation for this company. So let's calculate this first. So the number for the enterprise valuation is around 440.5 billion. So this is how much the whole company is worth. Then we're going to calculate the enterprise valuation to free cash flow ratio. So this is now when we divided the enterprise valuation with the free cash flow. We're going to use the free cash flow of 20.71. So the number we get is around 21.26. So this number is under 25, so it's a check here and is something we like to see. So this could be an indication for undervaluation right now. We can also calculate this number with the free cash flow assumption in 2027. This would be around 33 billion US dollar. So then we would get a different number. So the number we would get is around 13.34. So this number would look very low and this would be a high indication for undervaluation. Of course, this free cash flow assumption is something we don't really know. So let me know in the comments if you think this free cash flow assumption is too high. The next thing you're looking for is shares outstanding decrease. This means the company buys back their own shares. We like to see that, especially if we think the company is undervalued. So we're going to take a look now and we can see this company buys back a lot of their shares many years in a row actually, especially in 2019 around 1.25%, but also 2023 over 1%. So we like to see that this can help the stock price to increase as well. So it's a check here. I would like to give my conclusion about this company, so let's start with a positive. So I think we had a strong revenue growth in the last 5 years. This is something we like to see. I also think there's a decent free cash flow growth as well. The free cash flow yield around 5.32% is also looking quite good. Then we have the free cash flow assumptions for 2027. The free cash flow yield would be around 8.48%. The enterprise valuation to free cash flow ratio around 21.26 is also looking quite good. And with our free cash flow assumptions for 2027, it would be around 13.34. So to me, this looks like an indication for undervaluation. I also think we have a good balance sheet, which means a low amount of debt and a good amount of cash on hand. Also, we have stock buybacks in the last 5 years. This is something we like to see as well. And the inconsistent free cash flow would be something what we don't like to see. So in some years we had the free cash flow growth, but we also saw some free cash flow decline as well. So overall, I think this company could be fair valued right now, or is also looking undervalued if you expect the free cash flow to grow way more in the future. If you found this video helpful, don't forget to like and comment and subscribe for more content.